And I want to start on the FOMC minutes. When they came out last week, they created a bit of a stir. They showed a majority of Fed officials ready to calibrate rate hikes based on the fact that there's been so many, and you have to take lags into account. And to everyone, it implies a slower pace of rate hikes. Are you in this camp?
Yeah, as I think about it, we started the year with inflation high and rates very low. And it made sense to take your foot off the gas and move as quickly as you possibly could without breaking anything. But now our foot is off the gas. I think we're now on the brake. Real rates are positive across the curve. And when you're driving, you have your foot on the brake. You just drive a little more deliberately. Maybe you pump the brakes. You just take a little more caution. And so I'm very supportive of a path that is slower, probably longer, and potentially higher than where we were before that.
Potentially higher. So are you in the camp of various FOMC officials who are thinking that the rate that you get too restrictive with is going to end up higher than you thought it would be?
Certainly than I thought it would be a couple months ago. Inflation's been stubborner than I would like. And I don't start with the idea of a rate path. I start with the idea of getting control over inflation. And as long as inflation stays elevated, it just makes the case to me we need to do more.
So, let me put this in context of today, because you see the Fed needing to slow down, but you're also needing to get restrictive, more restrictive, that is. So why would you commit to getting less restrictive now if you're not even sure how high it's going to go? And I mean getting less restrictive by slowing down the pace of rate hikes.
Well, you know that monetary policy works with a lag. Famously, these lags are long and variable. That means you need to be aware of them, but you can't actually count on them. And so the way I think about it is it's helpful to be somewhat more cautious as you're in restrictive territory, because you know what you're doing is going to affect things somewhere out in the future. That's different than slowing down. That's different than not moving. So I just think it's a better risk management approach to move a little slower as you collect the data now that we've got our foot on the brake.
Well, but lags work both ways. They work in terms of how quickly or how slowly rate hikes make their way through the economy. If you slow down the pace of rate hikes now, get a little less aggressive, you're not going to know for a while if maybe you needed to stay more aggressive. You needed to keep raising rates more aggressively. You might have to start raising them in larger increments again.
Well, I look hard at forward-looking real rates. I think that's a pretty good indicator of whether you're restricting the economy or not, because it brings into account both where your rates are and where inflation expectations seem to be. And right now, inflation expectations seem to have stayed stable, and we've taken rates up now almost to 4%. So if inflation stays high, we'll keep doing what we need to do on rates. And I'll just be watching those forward-looking inflation expectations to see how high we need to take it.
Would that include moving back to 75 basis point rate hikes if you have to?
I never predict where we need to go in advance. We're going to do what we need to do when we get there.
The door would be open to that, though? If that was something you needed to do, is everything on the table, including 75 basis point rate hikes if needed?
Of course, we'll do what we need to do when we get there.
Okay. Well, in terms of why you want to go a little more aggressively, we know that you're trying to bring down inflation by slowing down the economy, by slowing down final demand. And we look at something like the Atlanta Fed GDP tracker, it's up to 4.5% for the latest quarter. Is that one of the reasons why you still think you need to be restrictive? Is that one of the reasons that might argue for keeping a slightly faster pace?
Well, we've definitely seen monetary policy work as you'd expect in places like imports, in places like housing. It really hasn't slowed consumer spending as much as you'd expect. And I think that has to do with the excess savings that were accumulated during the pandemic. It also doesn't seem to have slowed business investment as much as maybe you'd expect. And I think that might have something to do with elevated earnings. It might have something to do with people's perspective that this would be a relatively short slowdown if we were to have one. And so there's probably still more on the demand side And then demand feeds into pricing. And on the pricing side, I still am talking to people who are taking price and taking price at a level that makes me not yet comfortable that inflation is going to settle without more activity from us.
Well, in fact, it seems like a lot of the applause for improvement in inflation has to do with the headline CPI. The core PCE deflator has stalled out. It is not continuing to come down. What does that tell you about the course of inflation and the amount of restrictiveness that's going to be needed?
Well, we got a welcome CPI last month. It's the first one in ages that lower than forecast. But I take your point. I think if you took food and gas and shelter out of CPI, you actually had inflation being negative. But of course, the things that matter to people are food and gas and shelter. So unless we're able to get the core of what matters to people down to a level where it's in line with our target, I think we're going to say the job's not done.
Are you concerned about supply shocks? I had another Fed official stressing that today. Many people have, that if you continue a series of steady supply shocks is the kind of thing that could keep inflation high and could start raising inflation expectations, again, tilting you, I presume, towards the more restrictive rate. What do you see there?
Well, the places to watch on that dimension right now are obviously China and Europe. China, there was a lot of headlines today about COVID, and that's a place we've already seen how that can drive supply shocks. In Europe, I just hope they're able to get through the winter from an energy standpoint without disrupting the manufacturing industry there. So you definitely look at supply shocks, you look at that, absolutely. But I think it's much broader than that. You've got to look at all of the risks. And those include supply shocks. Those also include what's happening on the labor front. You can talk about rail in the U.S. and what might happen with that contract. In the business I'm in, you want to make sure you're thinking about all of those.
You have said in the past month that you see not your base case, but that the rate that is restrictive that the Fed gets to could be 5% or more. Do you still see that? Do you have another view that maybe it's going to have to move even higher?
Yeah, I don't think I've actually said that, Kathleen. I try hard not to focus on any individual number. What I do think is that as we see inflation come in, the inflation prints come in, we're going to have to react. And I don't see there's any particular number that I focus on. I focus on demand and I focus on inflation and what we're going to have to do to get those down.
I want to come take a look at financial conditions because they have been easing as markets got more comfortable with the outlook for inflation and perceiving that they see a somewhat less hawkish Fed, maybe not dovish, but not as hawkish with this slowing down in the pace of rate hikes. Is that an issue for the Fed as you try to drive policy? You want and need to see tighter conditions, and yet that's a force that potentially works a little bit in the other direction. How do you view that? How do you deal with that?
Right. I try not to focus too much on the equity markets or even on bond rates, but I am trying very hard to look at forward-looking real rates. And the way I think about it is, what the government bond rate is versus the market swap or TIPS indices of inflation expectations. And with the last CPI, you saw those inflation expectations come down significantly. And so I think some of the longer bonds came down significantly too. The gap between those two is still, 1 year, 2 year, 5 year, 10 year in the 1.5% to 2% range. And that feels like a good restrictive real rate to me. We may learn more on what happens to inflation over time, but those don't trouble me. If those were to narrow, then I'd want to think about it some more.
Is slowing down the pace of rate hikes part of the attempt, the hope that the Fed can engineer bringing down this very high inflation rate towards 2% without causing much of a recession with something like a soft landing? Is that part of the strategy?
Well, you always hope that, but I think the challenge when you're dealing with controlling inflation with long and variable lags is that if you get caught up in the dimensions of the landing, I think you miss the point. And the point is getting inflation and inflation expectations under control and anchored. And so I'm just focused on that. And of course, you'd like to do that with as little damage as possible. But the main point is that we want to do that.
The main point is that you want to try to achieve
control inflation.
Control inflation.
Correct.
But you aren't worried about the soft landing. So if you're not worried about a soft landing, why do you slow down rate hikes now? Why not just keep going at this pace until you can see more evidence that you're actually at the point where it's starting to work?
No, as I said, you obviously don't want to do damage you don't have to do. But the focus is on inflation and getting inflation under control. The focus isn't on trying to somehow warrant a particular version of a slowdown. What you're trying to do is get inflation under control.
All right. So in terms of some other issues on the table there, what are you making now of the balance sheet process, starting to bring it down more? Is it going to add to the restrictiveness? Is that even part of the reason why you say maybe we could ease off on the size of rate hikes?
No, I think we've launched the balance sheet process. So far, so good from my standpoint. I think the idea is to try to send monetary policy messages through rates, not through balance sheet. I do think that there is some restrictive element when you reduce the balance sheet, but I think the main message to send is rates. And I'm hoping that we can normalize the balance sheet in the background and not spend too much time worrying about that.
We're going to get a big jobs report at the end of the week, and it's going to be, one of the last two you get before the December meeting. What are you looking for, and how do you think it will jibe with your view of the economy and where it's heading?
We'll see what we get when we get there. We've also got a consumer spending report. We've got the PCE coming this week. We've got a JOLTS report. So there's a lot coming in. What I've seen so far is a labor market that still is quite tight. It's particularly tight in the skilled trades, and that doesn't seem to be easing much. It does seem to be easing in the professional segment. We've seen a bunch of announcements from the tech companies in the last couple of weeks that perhaps have changed that market a little bit. But I still think in the skilled trades, it's quite tight, and I'm still talking to employers who are hiring. And so I expect to see a continuation of solid job growth, but we'll see.
And solid job growth, presumably another reason why Fed policy may have to get to restrictive, maybe even risk going above restrictive and stay there for a while. I guess that's the question, because the market thinks as soon as you start pausing, the next thing is, oh, it's time to cut rates. Again, do you expect rates to go up and stay there high for a while, or do you think it's possible that you'll say, okay, we can start looking the other direction?
Well, Marvin Goodfriend was a Richmond Fed economist and a legend in our shop. And he made a very good point in a bunch of work he did that the Fed can't really operate well with stop-go policy. The mistake is to let your foot off the brake too soon. And the message that I've learned from his work and that of others is you've got to take inflation, you've got to get it under control, and you've got to make sure that you've got it under control before you do any talk of loosening.
May I ask one more question there, a brief one?
Sure.
Does that mean that you could see the rate going up, staying high through 2023, even into 2024? I know you don't like to predict exact dates, but could you envision that kind of scenario?
Sure. It depends a lot on what we're seeing on the inflation side.